I want to thank the guys at HOA Assist for inviting me to come talk a little bit more about association lending. One, I'm super passionate about it, but two, what they do, part of their mission is education, right? So to be able to give this information out to board members is important to me because I want this to be clear. And if we can try to get it distilled where everyone can understand it, it just makes things a lot more fluid and a lot more transparent. Association financing has been even more important lately with the rising interest rate markets. And you're seeing some things on the contractor side with supply chain shortages or labor shortages, things like that. And so to be able to get in, get a proposal, try to lock your rate for 30 days so you can continue to move the process along, it gives you a little bit of insurance in this interest rate market that is rising. I think one thing that gets overlooked when a board goes out to obtain financing is that it will increase your property's value, or it should. And that's something that a homeowner can take pride in. Some important things to know about association lending: there's no mortgage being filed on the individual unit owner. So this is something that the association, which is an entity, a company, that's designed to not make money, because it's usually a nonprofit, to take out for themselves. HOAs can pursue financing for a variety of different reasons. Some have clubhouses, the roof that needs to be replaced, siding. A lot of it is exterior. They might be buying a chunk of land that's adjacent to their property and they want to grab that and build on it and expand. They might need roadways that need to be replaced. It all depends too in the place that you live, the geography of where you live. So if you're in the Southwest and it's hot, you might have different needs than if you're in the Midwest and it's cold. This is very different from applying for credit personally. There's no credit report, there's no mortgage, there's no appraisal, there's no title. It's very different. The association would pledge their assets, which would be the assignments of the association dues, to the bank. And so it would be what a rent roll is to commercial lending, and that would be the lifeblood or cash flow and how you get credits and how you're eligible. So there's a couple different ways that you can go about doing a project. You can pre-fund, which almost never happens. You can do a special assessment, or you can borrow the funds. Sometimes you can do a loan and a combination where you borrow the funds and special assess. That's probably the most common actually, but there are multiple ways that you can grab financing. You get a reserve study back, and your reserve advisor said that you're going to have to replace your roofs in a couple years, and so you are actively putting money away for that project. Special assessment, that depends on your governing docs. So usually you can get approval by the board, or you can get approval by the homeowners. Rarely do you have documents that say that they can do that unanimously without consult or a special meeting, but more than likely you'll need approval somehow. If a homeowner leaves during an assessment, it usually is assumable. So that next homeowner would have to come in, and it's disclosed in the resale documents that there is a current special assessment or a pending special assessment coming, and that homeowner would have to be aware of that. Sometimes a homeowner can choose to pay that off at closing. Association lending is a little bit more complicated. It's a hybrid lending that most banks don't participate in. There are a handful of banks, mostly national banks, maybe some community banks, that do this type of financing. One of the biggest things they look at is cash flow. So usually you have to have a qualified debt service coverage ratio is what it's called, and that's them going through your income statement, looking at any kind of cash expense or non-cash expense items and adding back what can be added back. Reserve contribution is a big line item. A lot of boards might think it's easier for them to go out and get financing or try to find bids themselves. But what you might not know is there are a lot of requirements involved from a bank that you need to be aware of. How many delinquencies do you have? How many units do you have? What does your cash flow look like? How long do you want to amortize the debt? Is there a prepayment penalty? Is my rate adjustable? There's a lot of factors involved with this. Financing, it moves at the speed of the board. So usually there needs to be a contractor who's been selected and some kind of a bid, even if it's an estimate. It does not have to be a final bid, just a place for the bank to start and understand what the cash flow of the community looks like, and then we can go from there. So then I would need the budget, the balance sheet, the income statement, and the delinquency report, because there are different metrics that a bank looks for. Like 10% delinquency is very common. Rental to owner ratios can be estimated, but if you have a report that shows what that percentage is, it is very helpful. It's usually a very fast process. A lot of times attorneys are involved to put the loan package together, and you would have an attorney from the association to review it, and you'd have an attorney from the bank or the vendor put it together. Typically a closing on something like this could go as fast as a couple weeks. Sometimes they take 60 to 90 days. It just depends on the backlog and the credit behind the bank that has been chosen to do the financing. Recently too, with the events that have happened, like Surfside, as unfortunate as that was, you're seeing some legislation come out that's making it more important, especially for condos lately, grab financing, or at least look into it, because now Fannie Mae and Freddie Mac won't put any kind of debt on units that have deferred maintenance out of safety concerns. HOA Capital really happened by accident. So I grew up, my family has had a management company for 50 years, and I've been in banking for 10. A lot of what we do is education. So explaining to the board the different options that are available for them. What would be something that a bank would look for? How fast could this close? How much is it going to cost them? Is the interest rate variable? Are there guarantees involved? How long can they amortize the debt? Those are all really, really common questions. HOA lending is a very specialized market. And so this is all we do. This is all we do, and I love it. And so I want to help anybody who's interested in learning more about how to improve their community, maybe make their community safer, and just make the people who live there happier about where they live.